Hello, everyone. I just wanted to do a quick video and talk about some of the definitions that we'll be using when we talk about health insurance, particular terms and that are going to be applicable. So we're going to go over premiums. We're going to go through and talk about the open enrollment when we're signing up for health insurance and what that means. We'll mention deductibles, think about copay and coinsurance, talk about the out-of-pocket maximum and types of insurance and insurer networks. We'll be talking about HMO, PPO, POS, HDHP, HSA, and fixed indemnity insurance. And then we'll also mention at the end balance billing. So first, the premium. The premium is the amount that you're going to pay to actually have insurance. It's kind of buying the policy. Often health insurance is paid in monthly installments. Health insurance, typically you can't buy whenever you feel like it. There's often what is known as an open enrollment period. This is true for healthcare that is sold on the exchanges. And it's also true typically for employer-sponsored health insurance. Now, those two don't line up. There's not sort of one national open enrollment period. An employer might have one. The exchanges have one that's nationally set. But there's a specific time that you have to make your choices, both about whether or not to have insurance and which type of insurance you want to buy of the options that are available. We might think later about why this is the case, why, unlike other goods, you can't sort of change your mind whenever you feel like it, only during these set periods, and they typically happen once a year. The next term I want to cover is the deductible. The deductible is the amount that you need to pay by yourself before insurance even thinks about starting to help pay. With car insurance, there's often deductibles for incidents. So there might be, for each accident, you might have a $500 deductible before insurance kicks in. Generally speaking, for health insurance, the deductible isn't per incident, it's for the year. So there's a certain amount that you have to pay out of pocket before the insurance company steps in to pay at all. And if you don't meet your deductible, generally speaking, insurance does not pay anything. That's not true for some particular services, like preventative services, where they typically cover before you even meet your deductible. They cover at 100%, but those are sort of exceptions. Next up is the copay. So the copay is a fixed amount that you need to pay per visit or per particular activity. It doesn't vary based on the cost of that visit or activity. It's often like a $10, $20 set amount. In addition to that, there's often what's known as coinsurance. And this kicks in again once the deductible has been met, but it's the percentage or share of healthcare costs that the patient is responsible to pay. So often you'll see around 10, 20, 30% coinsurance is common for in-network care. Out-of-network care can go up to 50 or 60%. And we'll cover the difference in very soon here. Most healthcare plans often have what is known as an out-of-pocket maximum. So this is the ceiling of the maximum amount that if you have this health insurance, you can pay in a given year. So this includes adding up things that you have paid for deductibles, co-payments, co-insurance. It does not include the money that you're spending to have the insurance, meaning it does not include the premiums. So after you have hit that out-of-pocket maximum, the plan covers 100% of your cost. So after that, you're kind of off the hook more or less. There are a couple of different main types of insurance. The first one is a PPO, which stands for Preferred Provider Organizations. With this set up, you are free to go to sort of any different providers. However, the insurance company has negotiated with certain preferred providers to be in their network, and they have agreed to accept a particular rate for reimbursements. The insurer often will try to incentivize its plan holders to see these preferred providers by having differential copay and coinsurance rates between them. But generally with the PPO, you do have flexibility, but there's a set of providers that are accepting their rates as such, and what is called in the insurance company's network. The POS type of insurance is very similar. POS stands for point of service. It works in a similar way. Often the difference is that with a lot of POS plans, you have to specify a primary care provider, and that primary care provider needs to be the one referring you to different specialists. So the POS plans can in that way be a little bit more restrictive. An extremely restrictive type of insurance is called the Health Maintenance Organization. With this type of insurance, you typically are not free to see any doctor that you want. There is a tight network of doctors in this HMO. Some of them, HMOs are set up where the doctors are basically owned by the insurance company. The insurance company and the doctors are in one organization together. Kaiser is a famous example of this model. And the insurance only pays for you seeing doctors in that health maintenance organization. Sometimes there will be some small pay for out of network, but in some HMOs, you cannot see any doctors outside of the HMO and get that reimbursed. Another term, it's not exclusive in terms of you can have both PPO and HDHP. This is the high deductible health plan. Once you know what a deductible is, it's pretty self-explanatory. So this is a plan where it's only really going to come into play if you have a really serious health event. Relative small events are going to not meet your deductible, and so you're going to be paying out of pocket for that. HDHP plans are basically insuring you against something more catastrophic. Most HDHP plans also come along with what is known as an HSA, or health savings account. With your health savings account, you are allowed to put money away in a tax advantageous way to save up for healthcare spending in the future, and spend out of that account rather than spending money that is kind of been taxed already. So there's a tax advantageous way to deal with that. And oftentimes employers set up accounts that are high deductibles. They will also be putting money in the HSA account. One final plan that's more rare plan type here is a fixed indemnity plan. This plan is a little bit sketchy. Fortunately, it's not that common. But instead of paying for healthcare cost directly, the fixed plan says, well, we're going to give you money if you have to go to the hospital. And we're not going to base that amount of money on how much it's costing you at the hospital or what's happening. We're just going to say, all right, hospital visit one day, here's $500. Doctor visit, all right, here's $20. Where the reimbursements are not based on the cost. And so you're not insuring yourself that way. They're based on what's happening. These often are not even kind of characterized by the requirement of insurance as that, because They don't feature things like fixed out-of-pocket maximums or things like that. And people really can buy these plans thinking that they're getting insurance and kind of get screwed over. One final thing that I want to mention is I talked about how there's in-network and out-of-network doctors. One thing that can happen is if you go to see a doctor and it's out of network and it bills you more than what the insurance is willing to pay, and this doctor is out of network, these doctors can then send the remainder of the bill to the patient, to you. They're sending more or less the balance. So to give you an example, if you're going to see a doctor, maybe you burned your hand, you go to the hospital, the hospital's in network, the doctor is not, which is a common and problem that many states and nationally we're trying to deal with. You see the doctor, he charges $1,000 for his services, sends the bill to your insurance company. The insurance company says, well, what we normally pay for these services is $600. So we'll pay that, and they charge you the copays based on that and co-insurance based on that. The doctor can say, well, I charge $1,000. So you're giving me this $600. I am going to send the rest of the bill to the patient. So they'll send the person who went to the hospital, whether you bill for $400, the difference between what they charge, $1,000, and what the insurance company was willing to reimburse. So those are a couple important healthcare terms. There's great glossaries out there. If you're looking up for more, you can email me if you have questions. I'm happy to discuss. Just let me know, and hopefully this video was helpful. Take care.